for its biggest weekly drop in 2 years. And bonds continue to sell off. The yield on the 10-year U.S. Treasury note rose to 2.5% for the first time since 2011. Pre-Bernanke, it was sitting at 2.21%. For more, we are joined by Peter Schiff, CEO and Chief Global Strategist at Euro Pacific Capital. Good to have you back with us, Peter. Thanks for joining us.
Anytime. Thanks for having me on.
So you must be hurting in the gold department. You've been a gold bull for a while, but it keeps cratering.
Yeah, it doesn't hurt me because I know fundamentally the market's going a lot higher. It doesn't bother me if some other speculators have gotten it wrong and they're selling their gold. It just means that my clients could buy more cheaper. We've been buying gold for over 10 years. We started buying it below 300, and we're going to keep on buying it. I think it's going a lot higher than the 1900 or so that was the peak thus far of the bull market. You see, a lot of people are selling gold because they believe Ben Bernanke. Even though he has a lousy record when it comes to forecasting, they think that the economy is recovering. In fact, we're on the verge of the next recession.
Why?
Yeah, I think we're going to be back in recession before the Fed even has it. Well, remember, the whole phony recovery was built on the foundation of the housing market, of the stock market. It was the wealth effect. It was people thinking they were richer and going out and buying things they couldn't afford with borrowed money. But now that interest rates are rising sharply and mortgage rates are going along with them, this mini housing boom is about to bust, and all of the jobs that were created as a result are going to go away.
So
all
you
the
think
confidence, all the spending, the unemployment rate's about to... Yeah?
So you think because of the rising bond yields, the housing market's going to crater again in the U.S.?
Of course, the only reason that it rose was because rates were so low. We had 3.25% 30-year fixed-rate mortgages. They're now 4.25%. They're about to go over 5%. Meanwhile, a lot of speculators, the big buyers were the hedge funds and the private equity guys, they're about to start selling the houses that they bought. They're not going to find tenants. Their exit strategy on Wall Street is gone. Meanwhile, the banks have been accelerating their foreclosures. They wanted to try to hit the bids while they were there, but they were too slow. So you're going to have all these houses on the market this summer. There's not going to be buyers. Meanwhile, the stock market's going to keep falling until the Fed comes to the rescue. Unless Ben Bernanke comes clean and admits there's no tapering, there's no exit strategy, that he is going to increase, not diminish QE, then the markets are going to keep falling.
So you think he should keep buying bonds, or the Fed should keep buying bonds at this rate?
Absolutely not. No. But it's going to do it. The Fed is going to do the wrong thing. See, if the Fed takes away the monetary heroin, then the U.S. economy is in rehab. But the Fed doesn't want that. The Fed is trying to keep the addiction going because they want us to stay high. They don't want to acknowledge how deep the problems are. The fact is, all the QE has exacerbated the very problems the Fed was trying to solve. We're in worse shape today than we were 4 or 5 years ago because all the problems are still there, except now we have more debt to deal with. But the Fed doesn't want to admit that. If Bernanke actually believed, his own hype, that there actually was a recovery, he was greatly mistaken. I think it's all been bluff. I think Ben Bernanke has got to be smart enough to know that this whole thing it's a bluff. There is no exit strategy. There is no tapering. But he can't admit that.
So what would you do? What would you do with bonds?
Infinity.
Let me just ask you specifically about bonds. Would you short? Let me ask you the question. Would you short
I would sell
bonds
them if I still owned them, but I don't. I mean, I'm short. Huh?
You're short bonds. You wouldn't buy them in anticipation of more easing, which is what you just said is going to come.
Yeah, well, I do think that they're going to eventually cry uncle. The Fed is, I don't know how much pain they're going to tolerate, but they are going to buy bonds. That will cause a short-term rally in the bond market, but long-term, the worst thing the Fed can do for the bond market is buy bonds. Because where does it get the money to buy bonds? It has to print it, so it has to debase the dollar. Meantime, all the bonds that the Fed bought as a result of QE3, the Fed is losing money on those bonds. It now is sitting on huge unrealized losses that are going to get bigger and bigger with every downtick in the bond market.
So what if you're an investor watching and you're holding a bunch of high-yielding stocks? What do you do?
Well, depending on the stocks that you have, I'm a long-term investor. I'm riding through the noise. I do expect the Fed to come to the rescue of the stock market, the rescue of the bond market, the rescue of the housing market by admitting that it got the forecast wrong, I think they're going to increase QE. So I do think stocks are going to go up. But I think you got to look around the world. I think there's a lot of value right now in a lot of these emerging market stocks that have been hammered in the past week. I think gold, you mentioned at the top of the interview, gold mining stocks, a lot of the Canadian names up there, they're giving these stocks away. That doesn't mean that if you buy it, it can't go lower, because it probably will, but you've got to be willing to ride it out, because by the time the dust settles, these stocks, I believe, are going to be much, much higher, not only than they are now, but than they were a year ago or 2 years ago.
Minute left. What about James Bullard, the St. Louis Fed president's comments today that Bernanke's comments were inappropriately timed?
Well, maybe they were naive, but I disagree with Bullard. Bullard's point was that the Fed should be targeting a 2% inflation. That's not its mandate. The mandate is price stability. Prices going up 2% are not stable. It is not desirable. But of course, the Fed it's like George Orwellian. They're trying to redefine a term. The Fed wants to create inflation, but the public benefits from lower prices, not higher prices. It's the government that benefits from inflation because it gets to inflate away its debts, and it gets to pretend that there's a recovery, but it's an illusion. It makes it look like the stock market is going up, but the money is actually losing value. But he's right about one thing. Bernanke is wrong if he thinks the economy is recovering, and he's wrong about the housing market. You know, he's got one of the worst track records out there when it comes to housing. He denied there was a housing bubble even after it burst, and in his most recent press conference, he declared victory. He said rising mortgage rates don't matter because real estate prices are going to keep rising. They probably already topped out, and the bottom's about to drop out of the market once again.
All right, Peter, we have to leave it there. Pleasure as always having you with us. Many thanks for making time.
Hey, you're welcome.